Hello, welcome back to class. Today we'll be looking at impairment of assets and accounting for provisions. Impairment of assets and accounting for provisions. And with this, we will look at concept and scope of impairment, cash generating unit, impairment losses and reversal, provision, contingent liability, and contingent assets. We'll look at the environmental and decomposing obligation and disclosure requirements. This is going to be a brief one. We have the notes prepared to deeply go into the topic. Impairment and provision accounting requires professional judgment to reflect economic reality in financial statements, and these standards ensure assets are not overstated or obligations are recognized when probable. And key standards covered include the IAS 36, which is impairment of assets, and IAS 37, which deals with provision, contingent liability, and contingent assets. Let's look at impairment of assets, which is IAS 36. The core principle under this is the recoverable amount is the higher of 1, fair value less cost of disposal, and 2, value in use. And an asset is impaired if its carrying amount exceeds its recoverable amount. Also, impairment loss is equal to the carrying amount minus the recoverable amount. When do you have to test for impairments? You test for impairments as per the annual testing, which requires 1, goodwill, 2, intangible assets with indefinite useful life, and 3, intangible assets not yet available for use. And you also test when indicators exist for PPE and other intangible assets. Let's look at the impairment indicators. We have the external and the internal indicators. For the external indicators, it's when significant decline in market value happen, also adverse changes in technology, market and legal environment, increase in market interest rates, and lastly, market capitalization below net asset value. These are actually the external indicators of impairment. And under the internal indicators, evidence of obsolescence or physical damage, worse than second one is worse than expected economic performance, and the last indicator is plan to restructure or dispose of assets. Looking at the cash generating unit, the CGU is the smallest group of assets generating largely independent cash inflow, and it is used when recoverable amounts cannot be determined for individual assets. Goodwill and corporate assets are allocated to the CGUs for impairment testing, and impairment loss is allocated first to goodwill, then pro rata to other assets. If reversal of impairment loss would happen, let's look into that. An impairment loss may be reversed if there is a change in estimates used to calculate the recoverable amount, and the expectation under this is actually that impairment loss on goodwill cannot be reversed. It's important to know that impairment losses under goodwill cannot be reversed, and the reversal is limited to the carrying amount that would have existed had no impairment occurred. So if it didn't actually occur, the reversal is limited to the carrying amounts. Looking at provision, which is IAS 37, the recognition criteria are below, and a provision is recognized when all 3 criteria below are met. The first one is present obligation, that is the legal or constructive, from a past event. Also, probable outflow of economic resources, and lastly, reliable estimates can be made. These three criteria brings about the recognition of provision. If the three are not met, then the provision cannot be recognized in this instance. To measure provision, the best estimate of expenditure required to settle the obligation, and for large population, there is need to use expected value. If time value is material, you measure at present value, and an example of this is warranties, restructuring, onerous contracts, and environmental cleanup. For contingent liabilities versus contingent assets, when we talk about contingent liabilities, this is actually the possible obligation or present obligation, the possible obligation or present obligations which are not meeting recognition criteria. There are possible obligations or present obligations not meeting recognition criteria, and it's disclosed unless remote. It's disclosed unless remote. And for contingent assets, this is actually a possible asset from past events, and it's recognized only when virtually certain. It is recognized only when virtually certain, and it can be disclosed if possible. It can be if possible. In conclusion, impairment and provision accounting are essential for faithful financial reporting. They require judgment, estimation, and rigorous application of IAS 36 and IAS 37. And a proper implementation ensures transparency, supports decision making, and maintains trust in financial statements. Thank you.